Thank you very much, Madam Chairman, and welcome Chairman Powell. When you're setting these rates and making these decisions and seeking that 2% magic number, are you considering the cost of borrowing for the United States, knowing that Congress has over borrowed and that we have overspent and that the national debt is at now at least 97% of GDP, and that we're going to face challenges of our own making. This is not about what the Fed has done. This is what about the Congress has done that you have to factor in to your decisions. Do you think about the costs of borrowing for the United States itself?
No, we do not, and we're not going to. In other words, that would be fiscal dominance. If we were, constrained in our monetary policy by the budgetary situation of the United States, and we're not. We're clearly not. The path we're on is not sustainable, but the level of debt that we have is not unsustainable. Is sustainable. Put it that way. So we don't think about interest costs when we make monetary policy. We think about maximum employment and price stability.
It's your opinion that the level of debt we have is sustainable?
Yes, I mean we have the largest economy in the world. We can service this debt. That's not the problem. The problem is that we're on a path where the debt is growing substantially faster than the economy, and that's kind of by definition in the long run unsustainable. And the way countries have gotten or fixed that is with longer term programs that have bipartisan support and that address the actual problem in the budget. That's really the formula.
Thank you. I'm going to switch to stablecoins. You're a member of the President's Working Group on Financial Markets. The working group called for bank-like regulation of stablecoins in late 2021. Then on January 3rd of this year, in a joint staff statement, the federal banking agencies stated that even after the bank's capital, BSA, AML, and risk management, a bank issuing a stable coin on a, quote, open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. I'm going to say that again. Even after a bank's capital, BSA, AML, and risk management, a bank issuing a stablecoin on an open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. So I'm a little confused about where we're heading on stablecoins. Does the January 3rd statement mean that the Fed has decided that stablecoins on a permissionless distributed ledger have no place in banks?
So I think that there are real concerns about permissionless public blockchains, and the reason is that they've been so susceptible to fraud, to money laundering, and all of those things. So I think what you heard from the federal banking agencies in one of their reports was that they would tend to look at those as not consistent with safety and soundness.
And what about properly regulated stablecoins? Do you think they could have a place in our banking system?
I certainly think that in a world of appropriate regulation, where the same activity, where stablecoin activity gets the same regulation as comparable products in different places, then there certainly could be a place for stablecoins in our financial services sector.
Thank you. The European Union, UK, Australia, Switzerland, Singapore, and others have all moved over the last few years to create a legislative framework for digital assets. The European Union in particular is attempting to be a standard setter again, like it was with its data protection rule. Is the United States in danger of being a rule taker, not a rule maker, when it comes to digital assets?
I do think it would be important for us to have a workable legal framework around digital activities. I think that is important and something Congress, in principle, needs to do, because we can't really do that.
Yeah, thank you. Senator Gillibrand and I agree with you. One area we've already seen is in the Basel Committee on Bank Supervision. They propose prudential treatment for crypto assets framework, setting forth banks' capital standards for digital assets. The Basel Committee's framework does not impose a capital charge for digital asset custody, whereas the SEC's Staff Accounting Bulletin 121 imposes a prohibitive capital charge through the back door and places consumers at risk in bankruptcy. Similarly, the Basel Committee framework allows banks to issue or hold digital assets on their balance sheet if the requisite capital is set aside. So back to January 3rd, 23, the Fed and other bank regulators have said that it is forbidden for a U.S. bank to conduct these activities no matter the capital. So my question is, what does the rest of the world know about digital asset regulation that we do not, that the Fed does not?
So as we discussed, this is an SEC staff accounting bulletin, and it's not something that the Fed issued, and I'd be loath to comment directly on it.
The issue is, and what concerns me, is that the Fed and other federal banking agencies are not following international norms on digital asset regulation. That's just my comment. Thank you, Chairman Powell, for being here. I now recognize Senator Smith.